So imagine the global economy is staring down the barrel of a catastrophic weekend war in the Middle East. Geopolitical tension is just at an absolute boiling point.
Right. I mean, the panic was palpable.
Exactly. So you do what investors have done for centuries, right? You grab the ultimate historically proven safe haven, you grab gold.
Yeah.
And it immediately blows up in your face. I mean, gold crashes 3% to a 4-month low right when you need it most.
It was a brutal wake-up call, honestly, for anyone relying on legacy economic models.
Seriously.
What we just witnessed over the past 48 hours leading into Monday, March 23, 2026, was, well, it was a complete decoupling of traditional market logic.
Yeah. Risk managers were bracing for a catastrophic supply chain breakdown, only to have the underlying parameters of that risk completely rewritten in real time.
Exactly.
So our mission for this deep dive is to look at the fresh market data, the order flow forensics, and the executive maneuvers, to decode exactly how a weekend of chaos triggered this massive algorithmic repricing.
Across all major asset classes, yeah.
Right. We want to understand what this localized panic reveals about the current structural reality of the digital asset market.
Which is fascinating, by the way.
It really is. Let's set the scene for you listening at home. The immediate catalyst was a highly rigid 48-hour ultimatum from the U.S. executive branch.
Right. They were threatening direct kinetic strikes on sovereign Iranian power generation infrastructure.
And the Iranian military apparatus, they didn't blink at all.
No, not even a little. They countered with a guarantee of mutually assured economic destruction. They threatened to deploy advanced naval mines across the entirety of the Persian Gulf.
Which is terrifying. I mean, if you paralyze that specific maritime corridor, you effectively shut off a massive artery of global hydrocarbon extraction.
Yeah, the market was looking at the mathematical certainty of regional infrastructure obliteration.
But then, early Monday morning, President Trump jumps on Truth Social and unilaterally announces a 5-day postponement of all planned strikes.
Citing productive diplomatic conversations?
Right. We go from the brink of a kinetic energy war to a sudden, diplomatically induced holding pattern. Okay, let's unpack this.
Let's go.
Because the way this specific diplomatic pivot shockwave through the markets, I mean, that's where the data gets incredibly revealing.
Yeah, the initial reaction was a violent crash in energy.
Right. We saw Brent crude plummet from a crisis peak of, $114 down to $98.66 in his barrel almost instantly.
Just fell off a cliff. West Texas Intermediate dropped 13% too.
So the geopolitical risk premium just evaporated. But returning to that aha moment I mentioned at the top.
Gold!
Right, gold. It was down 17% for the month of March, hitting that 4-month low right when fear was supposedly at its peak.
It's baffling on the surface. I mean, if you're sitting at home with a traditional 60-40 portfolio, you were probably taught that gold is your ultimate insurance policy.
It's, sir, that's the classic playbook.
But relying on it here is like jumping out of a burning airplane, pulling your ripcord, and realizing your parachute is made of solid lead. That's a great way to put it. It just drags you down faster.
So why did gold fail so spectacularly?
Well, if we connect this to the bigger picture, the trap with gold in this specific scenario is that it yields absolutely zero organic interest.
Okay.
When oil was pushing $114 over the weekend, algorithmic trading systems and bond traders were forced to price in severe supply-side inflation.
Because energy costs basically dictate the cost of everything else.
Exactly. And to fight that kind of embedded inflation, central banks can't stimulate the economy by cutting interest rates. They're forced to hike them.
Because if it costs more to produce and ship everyday goods, the only lever the Federal Reserve has to cool the economy is making the cost of borrowing money extremely expensive.
Right. And in a high-rate environment, institutional capital flows toward assets that actually pay a yield.
Makes sense.
The moment those rate hike expectations spiked over the weekend, machines looked at gold, an asset that costs money to store and pays you nothing to hold, and aggressively liquidated it.
So algorithms just don't care about the historical romance of gold during wartime.
Not at all. They care about the mathematical reality of interest rates.
Wow.
If your legacy analog hedge is systematically failing under the pressure of modern interest rate mechanics, right when geopolitical fear is at its highest, you have to seriously reevaluate how you protect your purchasing power.
So if traditional capital is fleeing gold because of, interest rate math, where is that liquidity actually finding a home over a weekend when traditional banks are closed.
Because that's where the data gets weird, right?
Super weird.
Yep.
While analog hedges were failing, Bitcoin went through a brutal microstructural liquidity squeeze and actually survived it to push higher.
Yeah, let's look at the timeline there.
Traditional banking rails are closed. High-frequency algorithmic market makers pull their liquidity because of the military ultimatum.
Right.
And the spot price drops to a trough of $67,371, testing the 200-week exponential moving average.
And that 200-week EMA is a massive psychological and technical support line.
It really is.
When the price hit that floor, we saw approximately $277 million in leveraged derivative contracts systematically liquidated.
Wait, explain that mechanical purge to me. Because a lot of the headline narratives screamed crypto panic over the weekend.
Oh, of course they did.
Right? And if I look at the chart, I just see a massive red candle.
Mm.
So how do we know that's not organic spot selling from long-term holders abandoning ship?
Because the order flow forensics tell a completely different story.
Okay, how so?
In a weakened liquidity vacuum, the order books are incredibly thin. A relatively small sell order can cause a massive price swing.
Right, there's no depth.
Exactly.
Right.
What we saw wasn't long-term holders moving their assets to exchanges to sell. It was over-leveraged traders who were betting on the price going up.
Oh, right.
When the price dipped slightly due to the macro fear, their positions fell below margin requirements. The exchanges forcibly sold their collateral to cover the debt, which drove the price down further.
Triggering even more liquidations.
Right, triggering more liquidations. It was a cascading margin call into an empty room.
So a mechanical purge, not a fundamental rejection of the asset.
Precisely. The lack of organic spot selling at that $67,000 threshold proves the existence of a massive, latent institutional bid.
The market was essentially just waiting for the dust to settle.
And we saw that latent bid materialize aggressively during the Monday morning European session. As soon as the news of the 5-day military pause hit macro trading desks, the bid-side liquidity reconstituted.
And then a violent macro-driven squeeze pushed the spot price right back up over 71,043 fulls.
Yeah, and it wasn't just a price bump either. Quantitative models printed a golden cross on the daily chart.
Right, that's the 21-day simple moving average crossing above the 50-day.
Exactly. And for trend-following hedge funds whose algorithms simply read momentum signals, that's a mechanical trigger to start buying.
It's all automatic.
Totally. But we also have definitive proof of structural resilience beyond the algorithms, right? We have the ETF capital flows.
Oh, the ETF data is wild. The verified settlement data for the week ending March 20 shows that despite all the geopolitical panic, the U.S. spot ETF complex saw a net positive capital injection of $95.18 million.
Which is the fourth consecutive week of net inflows.
Yeah, but the demographics within those inflows are telling.
They really are. BlackRock's IBIT absorbed $191 million by itself, while Fidelity's FBTC actually saw a $50 million outflow.
So how do we square that circle? Why is one monolith absorbing nearly $200 million, while another leaks $50 million?
Well, it highlights a bifurcation in institutional behavior. BlackRock's client base, often sovereign wealth, massive pension funds, and registered investment advisors, they're executing systematic, price-agnostic accumulation.
Meaning they're allocating a percentage of their portfolios to Bitcoin, regardless of weekend headlines.
Exactly. Fidelity's specific mix, perhaps skewing slightly toward tactical retail demographics or active managers, might have engaged in localized de-risking.
Makes sense, but the aggregate numbers are what matters, right?
100%. These ETFs now hold $90.3 billion.
Which is 6.44% of the total programmable Bitcoin supply, permanently removed from active circulation.
Think about the mechanics of that for a second.
It's acting as a thermodynamic floor. Every dollar flowing into those ETFs mandates the physical acquisition of the underlying asset.
Right, you're taking circulating supply from the open market, locking it in deep storage custody with a provider like Coinbase, and creating artificial scarcity.
But it's not just passive ETF allocators doing this.
No, not at all.
Operating companies and political entities are actively weaponizing their balance sheets to hoard this collateral directly, basically bypassing traditional credit markets entirely.
Yeah, we are seeing the aggressive financialization of corporate treasury.
Let's look at the European firm, capital B, right? They trade on the Euronext Paris exchange.
Right.
They utilize structured equity offerings, raising $3.5 million from traditional institutional investors. They took that fiat and immediately executed a direct acquisition of 44 more Bitcoin.
Bringing their consolidated treasury to 2,888 Bitcoin.
So they're essentially transforming their operating company into a synthetic, publicly traded Bitcoin ETF.
That's exactly what they're doing.
I mean, if you are a traditional European equity investor, you might be legally restricted by your mandate from buying cryptocurrency directly.
Sure, compliance won't let you.
But you can buy shares of Capital B. You get exposure to Bitcoin's price appreciation without having to manage private keys or regulatory hurdles.
And Capital B gets to hoard a non-sovereign bearer asset instead of melting fiat. It's a win-win for them.
It's brilliant. And this strategy is simultaneously playing out in the decentralized finance space, too.
Oh, especially among politically affiliated entities.
Right, like World Liberty Financial.
Yeah, the crypto ecosystem associated with the Trump family. They are executing an absolute masterclass in treasury migration.
Forensic ledger analysis shows they deployed $5 million into wrapped Bitcoin, $1.4 million into the FRD token, staked over 2,000 Ethereum, and deposited 5 million USDC into the AV lending protocol.
What's fascinating here is the strategy behind it.
Let's break down the why and how behind that list, because it sounds like a lot of jargon to some, but the mechanism is fascinating. Why wrapped Bitcoin? Why Avive?
Okay, so native Bitcoin doesn't natively interact with Ethereum smart contracts.
Right.
By using wrapped Bitcoin, they bridge that value onto a programmable network.
Got it.
And when they deposit 5 million USDC, which is a dollar-pegged stablecoin, into a protocol like Avive, they are acting as their own prime broker.
Which is a huge shift. In legacy finance, if you have millions in capital, you give it to a prime broker who lends it out and gives you a fraction of the yield while pocketing the rest.
Exactly. But Avive is an eponymous, code-based lending market. By depositing there, World Liberty Financial earns the full lending yield directly, second by second.
So they're basically acting as their own digital central bank.
Yeah. Politically exposed persons and legacy European equities are looking at the traditional banking system with its counterparty risk, weekend closures, and clearinghouse fees, and migrating their treasuries natively on-chain.
But here is where the narrative takes a massive physical turn.
The hardware side.
Yeah. While the software layer is soaking up all this capital and integrating into traditional financial plumbing, the physical layer, the actual infrastructure required to run the network, is facing a terrifying bottleneck.
The hardware reality is definitely catching up to the software abstraction.
Seriously.
Securing this network requires silicon and electricity, and we're entering an absolute war for those resources.
So over the weekend, Elon Musk had to clarify the architecture of Project Terafab, right?
Mm-hmm.
The joint venture between Tesla, SpaceX, and XAI.
Right. There was some confusion about that.
Yeah. The facility being built in Austin, Texas is just a prototype hub. It's designed for mastering 2-nanometer lithography for their AI5 and D3 chips. But the true Terafab, the facility designed to hit 1 terawatt of annual compute, is going to be built elsewhere.
And the scale of a 1 terawatt facility is almost beyond comprehension.
It's insane.
Wall Street estimates suggest that achieving that scale requires between 7 million and 18 million wafer starts per month.
What?
And the capital expenditure isn't the 25 billion being discussed initially. True estimates range from $5 trillion to $13 trillion.
Okay, let's pause on that number. $5 to $13 trillion in capital expenditure.
It's massive.
But how does an AI hyperscaler building supercomputers actually threaten a Bitcoin miner? I mean, they aren't mining Bitcoin?
No, but they are competing for the exact same physical choke points in the global supply chain. Advanced chips, whether they are AI processors or Bitcoin ASICs, require cutting-edge silicon wafers and specialized packaging lines.
Right. And there aren't many places that make those.
Exactly. Right now, there are only a handful of foundries in the world, primarily TSMC in Taiwan, capable of producing these 2-nanometer nodes.
So it's like trying to water your garden while the city is redirecting the entire reservoir to a nuclear plant.
That's a perfect analogy. Or like trying to book a single commercial flight, but you find out a massive global conglomerate just chartered every single plane in existence for the next 5 years.
You simply cannot get a seat no matter what you're willing to pay.
Exactly that dynamic. When apex AI hyperscalers command trillions in capital, they monopolize the foundry nodes.
Right.
They buy up all the high-bandwidth memory packaging. They secure all the high-voltage energy substations from the local grids.
So if you are an undercapitalized, mid-tier Bitcoin mining operation, you are systematically priced out of the hardware procurement cycle.
You can't get the chips, and even if you could, you can't get the power.
This mathematically guarantees a brutal consolidation in the Bitcoin mining sector, doesn't it?
Oh, absolutely. Operators will either have to secure massive capital injections from Wall Street just to afford the hardware, or they will be forced to capitulate and sell to larger players.
Which perfectly segues into the final piece of this macroeconomic puzzle.
The regulation.
Yeah. As institutional capital floods the software layer and AI giants consume the physical hardware layer, the U.S. government is finally being forced to domesticate the sector.
The Digital Asset Market Clarity Act is really coming to a head now.
Senator Cynthia Lummis confirmed they are targeting an April vote in the Senate Banking Committee.
And the timeline there is stark. If it doesn't pass by May, the legislation is dead for the year.
But to get it to this point, they had to broker a massive compromise regarding stablecoins.
Right, that was the sticking point.
Wait, I need to stop you there, because we've seen internal analyses warning that the banking lobby was terrified of losing up to $6.6 trillion in deposits if stablecoins were allowed to offer passive yields.
Yes, that was a huge concern.
If that's true, why would the legacy banking sector ever allow this bill to move forward in the Senate? What's in it for them?
Well, you've hit on the existential threat to commercial banking right there.
Right.
Banks operate by taking your deposits, paying you a tiny fraction of a percent, and lending that money out at a higher rate.
Sure, that's their whole business model.
If you could hold a digital programmable dollar on your phone and earn 5% passively, the incentive to keep money in a traditional checking account vanishes entirely.
It would trigger a catastrophic $6.6 trillion bank run.
Exactly. So the compromise they brokered explicitly bans passive stablecoin yield. You cannot earn returns simply for holding a dollar-pegged token in a wallet.
So they protected the banks.
They did. However, the bill permits activity-based rewards.
Okay, meaning what?
You can earn yield tied to transfers, payments, or active protocol use.
Gotta.
It's a protective victory for legacy finance because they maintain their monopoly on risk-free interest generation for passive deposits.
But simultaneously, it provides a fully compliant legal framework for crypto-native platforms to operate within the United States.
Exactly.
And the macroeconomic implication of this is brilliant from a sovereign perspective, honestly.
It really is.
Because think about how a stablecoin works. To mint a digital dollar on a blockchain, the issuing company has to hold an equivalent asset in reserve.
Right.
But they don't just hold cash. They hold U.S. Treasury bills.
Yeah. By providing regulatory clarity and domesticating stablecoin issuers, the United States government is effectively using cryptographic architecture to synthetically generate global demand for its own debt.
Wow. It's like franchising the U.S. dollar globally without having to build physical bank branches.
That's exactly what it is. Anyone in the world with an internet connection can hold a dollar, and by doing so, they are indirectly funding the U.S. government's deficit.
The state is literally cementing the hegemony of the U.S. dollar in a digitally native format.
It's an incredible strategic move.
So what does this all mean? Let's bring this full circle.
Okay.
Because the sheer density of events in this 24-hour window proves that the old models are breaking.
They are completely broken.
We saw geopolitical brinkmanship, completely short-circuit analog hedges with algorithms dumping gold because of rate mechanics.
We saw Bitcoin weather a massive leveraged liquidation event and immediately absorb sidelined institutional capital via ETFs.
We watched political entities and public corporations bypass prime brokers to manage their treasuries autonomously on-chain.
We saw AI giants commanding trillions of dollars, threatening to consume the very silicon supply chain necessary for securing cryptographic networks.
And we watched the U.S. government architect a legislative framework to weaponize stablecoins for treasury demand.
When you synthesize all of that data, the fiduciary reality is undeniable.
It really is.
Bitcoin is no longer trading purely as a speculative technology play. It is functioning as a highly sophisticated real-time barometer for global sovereign liquidity.
Yeah.
It reacts mechanically to fiat debasement, infrastructure bottlenecks, and geopolitical containment in ways that legacy assets simply cannot replicate.
It's a completely new paradigm for capital preservation, and the mechanisms driving it are only getting more complex.
Oh, without a doubt.
Well, thank you for joining us on this deep dive. We've covered a massive amount of ground today, but I want to leave you listening at home with a final thought to mull over.
Yeah, let's hear it.
We started by talking about that expectation of predictable cause and effect in global markets.
Oh.
But if traditional safe havens like gold are failing because of the very inflation they were originally supposed to protect against,
Right.
and AI giants are preparing to consume the world's physical semiconductor supply,
Yeah, are we moving toward a future where the only asset that truly matters isn't the one that yields the most interest, but the one that requires the most thermodynamic energy to alter. Think about it. See you next time.